Thank you. Good afternoon to all of you. I think our Mr. Gajendra, the chairman of the Taxation Committee, has already introduced the topic and also gave a warm welcome to all our speakers who are present here. Recording. Okay, fine. Right. So today is, as was mentioned, another seminar. These are recent tax changes to SMEs and economy, especially the SME sector, the small and medium enterprises, because this month, the June 27th, is the UN MSME Day. So we thought that it will also bring to highlight to highlight the importance of the MSME sector and what the tax changes have done. So that was one reason that we brought in that, and then of course, as far as the economy is concerned. But before we go on any further, I just want to maybe to pay tribute uh, to 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 two great gentlemen who have been associated with CMA Sri Lanka from its inception. Now, the two of them, Mr. Ispan Satar Singh, who was a founder council member, and Mr. James Mehta, a founder advisory council member. They were both founder chartered accountants and also founder management accountants from Sri Lanka. So I think that's a great achievement for both of them. But I must also pay a special tribute to them because when we were forming the CMA or the Institute of Certified Management Accountants, many were not in favor, and also some of them who had maybe agreed earlier were really did not want to come forward. But I must thank these two great gentlemen who really supported us, and of course connected with them very many senior accountants, the senior partner of KPMG, the late Gamini Vijay Singh. He was also the chairman of our advisory council, and the current maybe current chairman of the advisory council, Mr. Hemakamara Surya, was also associated at that time. So just to say a little about Mr. Ispan Satarasinghe, he is really one person who used to ring me daily and wanted me to conduct these tax webinars. And because he felt that this knowledge should be given to a wider public, wider number in the private sector, in the public sector, for their own betterment. And every time that we organized, I know that all our speakers who are here will know the number of seminars that we have had and also the number of participants. Daily, he used to ask me how many. It was going up from 200 to 300 to 500 to 700. And he was the happiest person because he felt that the contributions made by our eminent speakers who used to come for this, and also giving it free to them was a big thing that he really supported. So I must really thank him for it was not only on tax, but maybe on other matters also. Even the last seminar we had on this current crisis, which was carried in all the newspapers, was also his own suggestion where he used to ring me daily. He used to look at the Daily Mirror and find various stories, tax articles written by Suresh Perra, his colleagues, and many others, where he was very happy. And he was the one of someone who started the tax oration at the Institute of Chartered Accountants, and tax was one of his key areas where he was also the chairman of Brook Bonds. And if you really look at it, both Mr. James Mather was one who really grounded, or who really maybe mentored and really made professional chartered accountants at that time. We were, of course, his own products, and he was someone during our article days, getting through, and even after, someone who closely associated us and supported us. In fact, I was supported to go into the council at a very young age at the Chartered Accountants, where was elected, and then, of course, became president and been able to do all these contributions because of the support that was given to us. Then I must also say that both of them were inducted to the Hall of Fame of the Institute of Chartered Accountants, and both of them received the what do you call the Hall of Fame, the highest maybe achievement by a chartered accountant or any professional accountant in Sri Lanka. So we are very sorry that we have lost two great leaders in the accounting profession, and may their souls rest in peace. Uh, Going on to our webinar itself, as I said, the small and medium enterprises, they are going through a lot of difficulties, but at the same time, there are a number of them who are doing well. But when you bring in a larger number like the MSMEs, you bring the micro, small, and medium enterprises, you find that there is a problem. Now, recently, our CMA has been doing quite a lot on this area. One was that we released the cost accounting standards. Now, this, I think, is something that we will be really taking to the government. In fact, the Deputy Minister of Finance and Planning came, and he launched the cost accounting standards. And this has to be used at all areas, because I know that Mr. Gajendra will be speaking on the economy. But if you look at the economy is maybe laid down by the economists. But ultimately, how it has to be operated, how it has to be planned out, how it has to be really taken forward, the whole economy taken forward. One of the major reasons that we went bankrupt is that we did not have professional accountants who were managing these finances. So now we do hope that with these cost accounting standards that we are putting in, that we will be able to ensure that the government will be able to use the resources in a proper manner, that they will be able to not only think that they are getting free money, but they should be able to use it and then see that there is value for money generated and value creation in these items. Then the next one, of course, we immediately had, that was yesterday, was the Cost and Management Accounting Excellence Awards, where we want to reward those who are maintaining records, those who are maintaining very good costing systems. One of the things that we have found missing is the cost accounting records. A lot of them are fixing prices. Now, recently we just heard about the buying price of rice. But whether they have a formula for looking at it, whether they are looking at certain standards, do they know what cost is? Have they taken into account the various subsidies that they are given? So there are very many areas that we have to be done, but most of these are today a guess game. And we as a professional body, not only we are incorporated by an act of parliament, which means that all the parliamentarians have passed it for the betterment of the society of this country. So the societal cost is the other area that we have to look into, and I'm sure that even in this tax seminar that we are talking of, that we will really find that the end, the person who pays the taxes, and of course the person who has to ultimately buy the goods, will also be affected. So maybe these are things that I do not want to talk, but maybe in the tax webinar, our eminent speakers will go through. I must thank all our eminent speakers for the great encouragement they have done to us. And I'm sure that we will be able to have a great webinar. And I must say that we may have to do a little change in the timing from 3 to 2:30. Plus, also, I had to change the mode of conduct. Earlier, we were going to do it as a meeting, but now we are doing it as a webinar. That would be the easiest mode and the best way that the presentations could be heard by the speaker. So thank you very much, and let me hand you over to our moderator, Mr. Gajendra.
Thank you, Professor. Next on agenda item is the presentation by Mr. Atula Ranavira, Managing Partner, Ranavira Associates, on the recent changes in income tax. Over to you, sir.
Thank you very much for the introduction. Dear all, now today what we at CMA plan to discuss about the recent tax changes in Sri Lanka. Now, when we take these tax changes, we have two main tax changes. One is the sales-based tax, which covers VAT and SSCL. As you know, the SSCL amendment has already passed in the parliament and is in effective. Then the VAT Amendment Bill 2026 is yet to be passed in the parliament. Then these two sales-based taxes, Mrs. Suleiman will cover that area. My role of duty is to cover the income tax amendment. As we know, the Income Tax Amendment Bill 2026 passed on 19th May 2026 and now it is effective. Few changes are there. We will talk about these changes connecting with the existing law. Right. Before covering my session, as Professor Watavala mentioned, I would like to recall late Mr. Esmond Satarasinghe, who recommended me to Professor Watavala, and thereafter we discussed and started this type of tax webinars through CMA Institute. I think most probably that happened in 2021 or maybe, yeah, I think 2021. From 2021 onward, we are conducting, as Professor correctly mentioned, we are conducting these free seminars, which is very much beneficial for each webinar. At least 500 people are participating, and it is mainly beneficial to the SME sector, the micro and the SME sector, plus the other taxpayers also. Now, as we know, tax is a direct, tax is a cost, which none of us are happy to pay. Why? Why? Because it is directly affecting to our disposable income. When it is directly affecting to our disposable income, there may be so many economic effects of these taxes. That's true, the government need money for various welfare activities and for various development activities. But at the same time, when they charge more and more tax, the disposable income reduces. As a result, our savings get reduces, then our investment ability get reduces, which might affect to the new investment projects of the country. Right. Knowing that, now we'll see what are the recent changes, what they have legalized on 19th May 2026. For that, I will share a document. After this session, we'll be sharing this document with you all the participants. Yeah. Now here in the first page, this is a short document. I will take maximum of half an hour. That means 320 by 320, I have to stop. Right. Now, the Inland Revenue Bill 2026 passed in the Parliament on 19th May 26, certified by the Speaker on 3rd June, and gazetted on 5th June. Now it is certified by the Speaker on 3rd. As per our country's constitution, a legislation get legal stand after signing by the Speaker. Therefore, the general effective date is 3rd June 2026. But in certain sections, there may be different effective dates which are specifically mentioned. Anything which is not specifically mentioned is effective from 3rd June 2026. Right. Now, this new Amendment Act, the Income Tax Act, is named as Amendment Act number 11 of 2026. Now, in my document, as usual, I have divided the document in and given a small index like a coverage. Now, in the classification under these headings, I have put singular words also for the benefit of some participants. Right. Tax rate changes. The changes, amendments which relate to tax changes, I have separated. Then the income tax computation related changes, then deductions and allowances related changes, withholding tax related changes, then installment tax computation and some set return filing, self-estimated tax return filing, I have separated. Then administration and compliance changes, then the penalties and enforcement related changes, then special industry related some changes, then information sharing, interest write-off clause. This is an amnesty. This law has given an amnesty. We'll talk about that. Then exemptions and sunset clauses, then the proposed amendments in the bill, there were certain amendments which are not legalized. As you know, there are almost 5 court cases, Supreme Court cases against the bill. As a result of these cases, government decided to withdraw three proposals, 3 important proposals. Now we'll discuss what are the 3 important proposals, what made them to withdraw. Because by studying those things, especially for the people who are in the practice and who are applying this law, it gives a lot of benefit for their technical arguments and interpretations. Therefore, these things, what they proposed and withdrawn, are very much important for us. Now we will see one by one. I have given this summary as I explained. Then the number 1, the tax rate changes, rate-related changes. Now, rate-related changes has happened only with relate to value, only with relate to investment capital gain, not the normal, not the business capital gain, only with relate to investment capital gain. As you know, a capital gain we can categorize into 2. If it is directly connected to a business, directly as part of the business, it is business capital gains. Those are taxed in under the business category. Then the other thing is investment capital gain, which are directly connected to the investment purposes. Right. In this case, the individual's investment tax capital gain tax rate of 10% increased to 15%. Effective from when? It is effective from 3rd June 2026. Effective from 3rd June 2026, the individual's rate as well as the partnership's rate has gone up from 10% to 15%. Then in the case of trusts and in the case of NGOs, in the case of trust and in the case of NGOs, it increased from 10% to 30%. Right. Now, I think it is clear. We move forward. Second category, income tax computation changes, computation-related changes. Right. Income tax computation-related changes, gains on disposal of motor vehicles. Now, when a business, when we are taking a business entity, in that business entity, there may be vehicles which are not qualified for capital allowances, depreciation allowances under section. Like in a normal office, a supervisory type of vehicles, which are not hiring, not using for hiring, no direct income, no direct transport of goods and passengers. Right. In that case, we are not permitted to depreciate it because it won't cover with the depreciable asset category. Now, when we disposed a vehicle like that, now the law amended to say that it is a casual nature and it is not liable to income tax. Actually, this is obvious. Even up to now, from the inception up to now, any of these type of gains on disposal of any asset, which are not categorized as investment, categorized as assets covered with investment capital gains or capital gains. Any asset which are not covered with capital gains and which is not covered with depreciation allowances, we were not paying income tax on that. Obviously, because it is under our tax law, it is a casual nature income. I can't understand why they wanted to highlight only the vehicles into this category. Actually, land and building, no need, because it is a capital asset held, which covers under the capital gain tax. Then certain financial assets need not to. Then membership interests need not to, because those are capital assets held for as capital assets, non-depreciated things. But there may be some other capital assets, some assets which are not, which are in accounting we recognize as long-term assets, but under the section 16 of the Inland Revenue Act, no depreciation allowance. Actually, this law should apply for any other asset like that also. But even this is casual nature, we know a lot of tax officials, they couldn't understand the theory behind that or principle behind. As a result, they were trying to tax this type of gains also. I think to secure the policymakers' intention, it made them to legislate this, which is not required, but anyway, it is welcome. Right. Then number 2, under that, life insurance policy receipts. Now, under the 3rd schedule to the Inland Revenue Act, there's an exemption for life insurance maturity benefits. Life insurance benefits. There are 2 conditions. At the time of receiving this life insurance maturity proceed, that particular person has to be an individual who is a citizen or who is a senior citizen of Sri Lanka. Senior citizen. If a senior citizen received life insurance maturity proceeds from a policy which was there for more than 10 years, policy lifetime more than 10 years, that benefit is exempted under third schedule. But if there's any life insurance maturity which are not covering fulfilling these two requirements, those receipts are liable to income tax at present. When a person who is below 60 years receiving liable. Now, what's the rationality of that? Now, this, when we take assurance policy, we have to separate the insurance and the assurance. Now, life insurance is an assurance policy because it assures that you are getting a return after now, even you didn't die, you are getting a return on a subsequent day. Then we call those things as assurance. In the case of assurance policies, the premium is deciding after considering not only the risk factor, but also this capital prepayment also. Premium contains two parts. We don't know how to separate it, but that is there. Now, if it is the situation, when we receive this maturity proceed, part of the proceed comprises the capital contribution what we have made and part the income earned on that. What's the rationality of taxing the capital component what we have saved? There's no rationality. Therefore, there was an unfair situation in the law. Now they have addressed that. Now, in addition, now any receipt upon death, maturity, or surrender of a life assurance policy is excluded from assessable income. It is an excluded income, right? However, the annuities, pensions, and business-related payments continue to be liable because otherwise people will do various manipulations. Then next, this is welcome proposal, right? The tax credit on receipt of arrears salary. Now, as you know, as per the section 21, the employment income and an individual's investment income should be recorded for tax purposes on receipt basis. The law says cash basis, which is not correct. It has created a lot of issues. What they could have to put is on the proper basis. Instead of proper basis, they use cash basis. Now, as a result, now if we'll take the cash basis, as per our labor law, March month salary to be paid on or before 10th of April. Suppose that company is paying on 10th of April, we need not to take the March month salary into that year of assessments taxable income because it is on cash base. Right? When it is accrual basis, we take it. Normally, we take it as accrual basis. But the law says cash basis. That is why I said that there's a misleading situation in the law. Right. Now, this situation has created a lot of practical difficulties, especially when we take the governmental institutions, including the universities. Sometimes the promotions get delayed by 3, 4, 5, 6 years. And when they get the promotion, it is backdated into a previous day and getting the arrears salary also. When they're getting the arrears salary is to be taxed at the time of receiving that money because receipt basis, no cash basis. Now, this may not be rational. Now, sometime back, we had a 18% tax rate, individuals, highest tax rate, 18%. Subsequently, they increased it to 36%. Suppose this arrears is relating to the period where the final tax rate, the maximum tax rate was 18%. Now, when we receive that today, and we have to pay 36%. There's no rationality in that. After addressing that, because actually this problem arises because of this weakness in the law. Right. After addressing that, now they says to adjust that they are giving a tax credit on that amount. Now they have given the formula to calculate that tax credit. You are getting a tax credit to smoothen the effect of that increased tax rate. I think it is welcome. I have given all these things with my comments also. The next, qualifying payments carry forward facility. Now, qualifying payments, when we make a qualifying payment, where we have to see whether we can carry forward or not. When we are donating any money to the government, there's no upper limit of claiming, but automatically upper limit is decided based on our accessible income. From the accessible income of an individual, we'll say accessible income of an individual, we can deduct the personal allowance of 1.8 million. After deducting the personal allowance of 1.8 million, then only we deduct these qualifying payments. As a result, there may be qualifying payments which are representing the donation to the government, which we can't claim in that year. But there was no carry forward facility. Now they are introducing a carry forward facility. I think that is very well. You can carry forward and claim it in the subsequent year. Next one, deductions and allowances related things. Cash payment, as we know, when we are making a cash payment above 500,000 rupees, equal of above 500,000 rupees, under section 10, it is not allowable unless we follow the 5 methods what they have given. Account pay check, account pay bank draft, credit card, debit card, online payment. If you have followed one of these 5 methods, then you can claim. If you have not followed any of these 5 methods, you can't claim. Now they are bringing the 5 methods, they are increasing to 6 by introducing, if we'll go and deposit money into the recipient's bank account, that is also accepted under this. That's good. Then enhanced capital allowances. Now, as you know, the 6th schedule capital allowances are already expired. Only now the 2nd schedule also, the minimum investment is 3 million US dollars, which is heavy. As you know, we are not getting any foreign investment into the country due to various reasons we need not to discuss. For years now, we are not getting material foreign investment. At least we should promote our local people to go and invest. To do that, they reduce the minimum investment of 3 million US dollars to 250,000 US dollars. Now you can make use of this. That's good. Then export-related payments. Export-related payments, actually, this is a sector where the head office is in overseas and branch offices or the liaison officers or subsidiary companies are operating in Sri Lanka. Head office is charging certain management fee to the local company. Now, this creates a lot of issues. Now, to minimize this issue, they have given, now they say, deduction facility on payment of expenses incurred in relation to export of goods and services with no Sri Lanka source. It is limiting a certain percentage. I think this is very important because otherwise people might misuse the section. Next, we have the amendments which relate to the withholding taxes. With relate to the withholding taxes, they have given some amendments. Now we will see. Withholding tax coverage is extended. Now, this is service withholding tax on service sector. When an individual is providing a service under Section 85, services provided by an individual is some services are liable to withholding tax at the rate of 5%. This 5% is a source of information plus small income to the government quickly. But the final tax rate is not 5%. 5% is only a withholding tax and not a final withholding tax. Now, in this category, in the law, there are certain specified activities of these individuals. To those activities, they have newly added another 29 activities like auditors, modelers, trainers, the coaches, and all. 9 where very new items are added. That's welcome. Then the next one, Withholding tax exemption on some individuals' interest income. Some individuals' interest income. Relaxation of withholding tax on deposit interest paid to a resident individual with no taxable income. Suppose there's a person who doesn't have taxable income. We'll say his total income is only 1.5 million a year, where the personal allowance 1.8 million. Therefore, there's no taxable income. In that case, if there are any withholding, their interest income, you can ask the bank not to deduct the withholding tax because there's no rationality of deducting. Therefore, this is a very rational amendment. Next, issuing withholding tax certificate free of charge. Actually, these withholding tax agents are the agents of the government, not our agent, not taxpayers' agent. Now, those agents shouldn't charge any fee from the taxpayer, but realize that there are some agents are charging. Therefore, they say hereafter no charges by the agents. If they want to, they have to negotiate with the IRD because with the principal, not with the taxpayer. Anyway, even the IRD is not paying. We also need not to pay. Now we will move to installment tax payment and the set return requirement. Now, installment tax return, tax payment, in this current law, there's a big error in the current law. There's no basis of estimation. It says you have to estimate the tax and pay 1/4 per quarter. How to estimate is missing. Therefore, they brought that into the law. But in 2006 Act, this was connected to the penalty clause. But this time it is not connected to the penalty clause, but they have given, says you have to estimate based on the previous year's amount. But there's a practical difficulty. First 2 quarters, how to base on the previous year is nobody knows. How to? Not practical. They have not interest to that. Legislator has not interest to that. Now, in 2006 Act, they interest to that. That is why they connected it to the penalty. But this time, it hasn't happened. This is a bad amendment. But anyway, something is better than nothing. Therefore, this is welcome. Right? You have to estimate, you have to take the previous year's tax and take 1/4 of that tax as your quarterly tax payment. Then, foreign tax credit. Now, in computation of the installment tax, the allowable foreign tax credit also to be considered. This was an error in the law, loophole in the law. Now they have brought this into the law. That's welcome. Then the set return. With effect on 2026-27, you need not to file the set returns. I can't understand the rationality of this. A lot of senior citizens requested not the requirement of set return to be eliminated, but I can't understand why they eliminated it. They could have to continue because this is an alarming thing for a taxpayer to file, do an estimate, file a return and get make the payments. Therefore, in my case, as a professional in the field, I'm not much agreeable with this. But this is the law. Next, administration-related things. Now, tax TIN certificate, 2023, they issued a gazette notification. This is the best change in the tax law in Sri Lanka. With that gazette notification, we can see the results now. Right. Now, this gazette notification, now they are expanding the requirements, so many requirements where the TIN number requirement is there. To open a bank account, building plan approval, motor vehicle registration, transfers, revenue license, then even not revenue license. Now, it is vehicle registration and renewal, yes. Land registration and business registration, so many things they have included. That's good. I think that is good. Next, tin upon company registration. Under the Companies Act, there's a section which says within 30 days of registering a company, you are supposed to get a tin number, a tax registration. But it is not practically effective. Therefore, now they are bringing the same thing into the Inland Revenue Act also. Within 30 days, you have to get a tin number. Then the next mode of tax return filing by a senior citizen, even at now at present, even the senior citizens is supposed to file the tax return electronically. But from next year, from this year onward, they'll be getting the relief. They can file the tax return manually. Then the next one, return filing exemptions. Now, suppose your sole actually in this, there's an error in this law. When they legislate the law and the amendment, they have made a big error in it. But anyway, the meaning is there, but legal error is there. Employees whose remuneration is subject to APIT and having interest income not more than 5,000 rupees and doesn't have any other income, is missing in this, right? Need not to file a return. But the banker will deduct 10% withholding tax. For that, you can give a request letter to the bank not to deduct. Suppose your income, the APIT income, the income is 1.8, we'll say 1.9 million. Then excess 1 lakh, the APIT table applied and deducted 6% withholding tax. APIT. Suppose you have interest income, bank is deducting 10%. Right. Then still in the first slab of 1 million, you have 9 lakhs for you to enjoy, whereas on the interest income, the bank has deducted 10%. Now there's a small issue in that. Anyway, it says you need not to file a tax return, but they have to do this correction in the section 94(1)(d) also. Otherwise, that might create issues in future. Then penalties and enforcement related. Now, they legislated that withholding tax agent, the penalty they introduced, if they not comply with the requirements, the penalty is 200,000 rupees. Individuals providing false statements, self-declaration penalty, not more than 200,000. Then the new prosecution action on offenses. Now they brought a prosecution action on offenses. In a way, that's good. I'm happy with this because when they give this prosecution, the offer, prosecution opening, tax administrator has to be careful. Tax administrator has to be careful. We know practically in certain cases it won't happen like that. Therefore, in future, the tax administrator also has to be very carefully apply the law, because they'll be in trouble because of this section for them as well. Then streamline recovery. The Commissioner General submit a certificate containing the tax, interest and penalty to the magistrate. Here it's good, but the problem, that certificate nobody can challenge. Who is the Commissioner General, a public servant, getting this type of superpowers? It is totally wrong. It's a violation of fundamental right of a person, but anyway, at Supreme Court also this law passed. Then protection from assessment. Individuals filing returns with 120% of the previous year's tax and giving an affidavit that he has filed a correct thing, then there won't be any assessments unless and until the IRD prove that he has done a fraud or evasion. What's the rationality of this? Now this is, I will give this offer, you pay tax and be silent. In tax law, that shouldn't be there, but unfortunately, see, in our country, this type of things are happening, which is not correct at all. Right. Anyway, what to do? This is the law. Right. Next, recovery residency rule. Yeah, with related residency rule, they brought the golden paradise visa holder shall not be considered as a resident for tax purposes. The next one, the overseas employment. If an employee individual leaves Sri Lanka for an employment which is more than 1 year, not less than 1 year, with an employer not associated in the previously in Sri Lanka, then commencing from the first day of the year of assessment until the expiry of the contract, he won't be an resident or non-resident. Right. Overseas employment. Now, specification is welcome to avoid misconceptions. I think this is good. Next, special industry related unit trust. Any unit trust who is not serving a certificate containing the income, exempt amount, withholding tax and other information will be on unit holders within 5 months. Results unit trust being deemed resident company and tax accordingly. Right. These days, this is happening. Some unit trust, some investment wealth management companies are showing that they are unit trust, but not registered as unit trust and doing this type of malpractice. Therefore, it is good. Then the nation and the Gem and Jewelry Authority, when the gem mining people sell the stone in the mining authority, when they auction it at the mining Gem and Jewelry Authority auction, they have to pay 2.5% withholding tax. That is a final tax. Then the National Gem and Jewelry Authority should file monthly returns on these things. Then the charitable institutions, for charitable institution, Commissioner General may grant, we have to apply to the Commissioner General and get this, may grant a tax credit equal to the tax payable by the charitable institution established for the provision of institutional care for sick and needy on their income. They can, on the interest income, they can get this exemption benefit. This is an additional benefit. Next, I have to rush now. Information sharing. Now, information sharing, IRD is having authority to that. They have added new 3 persons in institutions. Next, interest write-off. Now, this is another amnesty. Amnesty. Without calling it as amnesty, they says, if you settle all arrears taxes along with the penalties, the interest component will be waived off. Because interest is a mandatory interest, Commissioner General can't waive off. Therefore, they have amended the law to waive off the interest on the past taxes up to 24-25. You can make these payments within next 6 months. That means on or before 6 months from 3rd June, that is 2nd December. If you'll settle before 2nd December, you need not to pay interest component on that. Then that in the Revenue Act, then the Surcharge Act and the Finance Act is also covered with that. Next, government-assisted private school. If there's a private school which is getting government assistance under which that institute is registered under the Companies Act, they won't get this tax benefit. Then restructuring of concessions under 2006 Act. Now under 2006 Act, now the concessions, some of the concessions may be still continuing. After 31st March 25, none of those concessions will be continuing for that taxpayer. Then temporary concessions, all temporary concessions under the 6th schedule also will be abolished with effect from 1st April 25. Then proposed amendments, the thing capitalization, there are three items, last three items in my slide. What they propose in the bill and withdrawn at the Supreme Court level. One is thing capitalization rule. As a result of this, the Samsung Industries tile factory, Samsung Rajarata tile factory case, as the government, the IRD lost that case, the IRD wanted to prove that reserve includes negative reserves also, but they failed the case. As a result of learning this lesson, they wanted, or the government wanted, to amend the law by giving a new definition to say reserves include negative also. Now see, this is what's happening in Sri Lanka. No sooner the IRD lose a case, they try influence to the ministry to amend the law. This has happened in several cases. Even under the VAT law, unprocessed agricultural produce, they realized that they are in a bad wicket, therefore they included a definition to that. Right? This is something like that. Anyway, they accepted accepted and withdrawing. Second thing, life insurance business also, they presented against that taxing method, changing of the taxing method, they proposed in the bill, but Supreme Court level, they did. Then the third one, which is very important, document submission limit. Now, they wanted to bring a limitation which relate to the bill proposed to limit the time period of submitting the IRD requested documents or to 6 months if it is local, if it is overseas 9 months. If you're not submitted within 6 or 9 months, they wanted to bring that law, amend the law to say that you can't submit this law at the Tax Appeal Commission as well as at the courts level, which is not there. Tax Appeal Commission, now the courts level, the judgments are based on the question of law. Therefore, no problem. But Tax Appeal Commission, why they want to claim limit the Tax Appeal Commission? After the objections, anyway, they removed that. Right. That's all for the time being. I'm sorry, I have taken 10 minutes extra. I'll be sharing this document through CMA with you all. Even later, if anybody needs a clarification, my contacts and my tax manager's contacts are there. You all can send a WhatsApp message or an email seeking for any future clarification. Thank you very much.
Thank you, Mr. Ranavira, for your detailed presentation. Next on the agenda is the changes to the value-added tax and social security contribution levy, which will be presented by Mr. Sulaiman, tax partner at ENY. Over to you, Mr. Sulaiman.
Thank you, Mr. Gajendran. Let me share my screen quickly.
We can see now. Yeah, we can see.
Yeah, one minute. Right. Can you see my screen now?
Yes.
Right. Good afternoon, ladies and gentlemen, and to the panel and Professor Vatuvara. Thank you for the opportunity to take you through the bill that has been gazetted to amend the VAT law and the SSCL changes that have come about. So if you just go to the status of the bill, it has been some time now since the Gazette was issued in April 24, 2026, almost running into 2 months. So the normal course of events to make this a law would be it is published by order paper of Parliament, and then there is a 14-day lapse for the challenge of the constitutionality of the bill. I don't think anyone has challenged it. And then you have the second reading, third reading, and the certification from by the speaker for it to become a law. So all of these steps are still pending, and it is currently in the bill stage. So of course, subject to change and subject to enactment. The registration requirement change that has come about through this amendment is, I think, quite, I think it's known to everyone now. The threshold has reduced from 15 million taxable period or 15 million per taxable period or 60 million for 12-month period is the current threshold. It's still on until this law becomes effective. And then with effect from July 1st, 2026, what is proposed is it to come down to 9 million per taxable period or 36 million for a 12-month period. So if you look at it, it's a fairly steep drop and is most likely to affect especially the SME sector. So how will this affect the SME sector? Of course, I think the intention of the government is to expand the VAT net by bringing in more SMEs to the system. Now, if you recall, I think a decade ago, or when VAT and GST started, the annual threshold was only 12 million at that time, right? Then it suddenly went up to, it became 15 million, and I think it went up to 300 million a year. And now it's back, it was back to 60, now it's coming down to 36. So 36 is still 3 times more than what it was when VAT was initially launched. So to that extent, it is still higher than the initial intention, but still now coming down to 36 million per 12-month period. The positive side of it for the SMEs is that if anyone couldn't claim or VAT input was significant cost, now they can start claiming it, so it doesn't come into the it gets out of the value addition system, so you'll pay only on the value addition. So input is now claimable. Compliance requirements obviously will increase. VAT is not an easy tax to comply with. It has an output and input schedule, record keeping regulations, rules in terms of what can be claimed, what can't be claimed. So complexity will certainly come into those who are not compliant at the moment. And this threshold now matches the SSCL law. So it's those some of the few highlights on how it will affect the SME sector. Right. So when is it required to register? As per the bill at the moment, on or after July 1st, 2026, any person who carries on or carries out any taxable activity at register VAT, if the total value of supplies made in Sri Lanka during the taxable period ending June 30th, 2026 exceeds 9 million. That means any taxable period. Right? So if any taxable period up to June 20, so they are going to the past. The test is now in the past, exceeds 9 million rupees, you have to register. Or if the total value of taxable supplies, the 12 months ending June 30th, 2026 exceeds 36 million. So now these are all crystallized. So when you go back and see, and if you exceed 36, now you have to register by July 1st. So there, or the third condition is there is a reasonable grounds to believe that on or after July 1st, 2026, that taxable supplies in the next taxable period or next 12 months will exceed the respective thresholds. That means either 9 million you're going to exceed, or in 12 months you're going to exceed the 36 million. Then also you have an obligation to register. Right. So in this example, so if a person taxable supplies for the period ending June 30th, 2026 amounts to 9.5 million, or the last 12 months it was 37 million, or both of those exceed the threshold, you need to register for VAT starting from July 1st, 2026. Right. Then the other feature of the amendment to the VAT law, because so many SMEs and small traders are likely to come into the net, there is a concession provided on a transition provision that input credit will be given on a deemed input credit will be given on stocks that you hold. So it won't affect service industry. It will be a benefit to those who are in the trading industry mainly, or even manufacturing, where wholesalers and retailers. So many wholesalers, sorry, not manufacturers, wholesalers who newly register for VAT can claim now a deemed input tax credit on unsold stocks held at the time of registration, right, with effect from April 1st, 2026. Thereafter, if you register and you have stocks on which available, you can claim a deemed input. So what are the conditions for this? This credit will be available for goods except those exempt under the first schedule. So it has to be a liable good. The input credit is calculated using the VAT rate applicable when the goods were originally purchased and not the current rate, right? So it depends on when you bought it. So I think 18% has been there for some time. We had a 15 and I think 12. So you'll have to have proper records as to when you bought it and what was the VAT rate at that time. Then Commissioner General of Inland will prescribe a basis on which stock records should be presented for claiming this deemed input credit, which will have to be followed in order to get this benefit. Right. Then the next change is the VAT on financial services. What is changing? The rate is changing. It was 18%. It's going to go up to 20.5%. So basically, this 20.5 is not something additional. It is actually SSCL has been clubbed with VAT. So SSCL has been made exempt on financial services, and as a result, the 2.5% is getting added to this VAT. The amount to be disallowed in arriving at the income tax liability will obviously increase because VAT on FS is disallowed for income tax, whereas SSCL on FS was allowed for income tax deduction, right? So when you have the VAT FS going up, then the add back for income tax is going to be higher by 2.5%. So that will increase the effective tax paid out by banks and financial institutions or anyone who's liable to VAT on FS going forward. Then that comes into effect from July 1st, 2026. Then on the VAT on FS chapter again, they have amended or broad-based the calculation to some extent by changing the definition of emoluments. As you know, VAT on financial services is paid on value addition calculated as per the chapter in the VAT law. And in that, your starting point is your profit before tax. And then you make a few adjustments. One such adjustment to get that value addition to the profit before tax is the emoluments, right? So emoluments earlier, what you added was the emoluments. If you look at this for the periods prior to April 1st, 2018, emoluments include the gross remuneration payable to specified employees as recorded in the pay sheet. So that then doesn't include a lot of non-cash benefits, a lot of other benefits that are given to employees. However, the amendment says now you have to add not just what is in the pay sheet, but emoluments refer to gains and profits from employment as defined under section 5(2) of the Inland Revenue Act, which is very, very broad, right? And only excludes section 5(3)(b), which is talking about official reimbursement. So if an employee makes an official reimbursement, then that is not considered a benefit, so it's excluded. Other than that, all of the benefits given under section 5, whether it's in cash or non-cash, would now form part of this emoluments adjustment for VAT on financial services, which is very likely to increase the tax base. The change in definition of emoluments, so if you look at this is the extract of section 5(3), So this B is the only thing that is excluded, a discharge or reimbursement of expenses incurred by the Indian on behalf of the employer. So that is a official reimbursement if an employee makes, that is the only thing that is excluded. Everything else is going to be considered as emoluments. So the change in definition adds another complexity. Not only does it expand the scope, it now talks about the emoluments payable should be at fair market value, right? So that is going to significantly also affect all non-cash benefits given to employees, because they are now, for VAT, they are saying to go on fair market value of the benefit. So any returns filed for periods ending before January 1st, 2026 that complied with the earlier gross remuneration criteria will legally be treated as well. It's although this amendment is coming from 1st of April 2018, there is a deeming clause that says if you have filed your returns properly up to January 1st, 2026, that won't be touched. It is only subsequent to January 1st, 2026 that this emolument definition is going to change. Right. Then the change in change in emoluments, what has to be considered by banks and financial institutions is that only expenses that are directly incurred as reimbursement to be excluded. It moves away from the earlier approach where emoluments were broadly based on gross pay as per payroll records, and benefits now, such as things like tea, refreshments, uniforms, vehicle facilities given as non-cash benefits, housing given as non-cash benefits, and similar provisions may now be treated as emoluments at a fair market value, which has now been included into the law, that it should be assessed at fair market value. So these could be challenges that need to be assessed now, especially for those paying VAT on financial services. Right. The next change is on holding companies and investors. As you probably are aware, holding companies and investment companies have been having significant challenges with the IRD in terms of their dividend income, where the IRD has force registered several companies and is claiming that subscription to shares is deemed to be a financial service. Right. So this has brought in a bit of an issue with those in this segment, where dividends that are taxed, after taxing it in terms of taxable income, you tax the dividend again, and then once it comes to the holding company, having to pay another 20.5% of that is going to sort of significantly erode the returns to ultimate shareholders. So on that basis, I think the policymaker has now come forward with an amendment seeking to provide clarification as an avoidance of doubt to exclude dividend income as being treated as business profits. So they're saying it's not business profits. If it is not a specified institution, that is something like a bank or a regulated financial institution, or so there's another condition, it's excluded for banks, and it is excluded for anyone still doing business or any other specific financial services, which you can see highlighted here. So if you see, these services are not excluded. So for example, the operation of any current deposit or savings account, exchange of currency, these are all in the VAT law. These are the financial services definition. So if you're doing any of these and having dividend income, they are saying still the dividend income is likely to get captured. So the only exclusion they are giving from this amendment is if you solely have dividend income and not having any of these other financial services, and the one that is of concern is the one before the law, the provision of any loan, advance, or credit. Right. So just to take some time to explain this to you, the provision of loan, advance, and credit, the department has taken the position that any fixed deposit or investment in a treasury bill is a loan you are giving to the other party. Right? And as a result, holding company, most of them will have obviously have deposits, are anyway doing financial services. So once you get trapped under that segment, your dividends automatically is going to flow. So this amendment is not going to help that argument. So if you have a deposit and you're getting interest and the department is saying is a loan given, that means you're doing financial services, then this amendment won't hold, because the amendment says only when you have dividend income will it be excluded. So there's an interesting case. I don't know whether you saw it. It was in the FT this week, which this very specific point was addressed for primary dealers, and I think this can also make use of it, where they say primary dealers investing in treasury bills is not a financial service. Rather, it is an investment. It's not a loan given to the government, but it is a only an investment, and hence should not be liable to VAT on FS. So that, I think, brings a lot of clarity at appeal court level to the industry, and hopefully this will give clarity to the IRD also to sort of minimize unnecessary assessments. Right. Then the other significant change is the VAT on digital services provided by non-residents. So this applies only to non-residents. Resident companies need not worry about it. Okay? But the impact a non-resident charging a resident could have issues for resident companies. So to that extent, it's important. So this has also had a very long, tedious trajectory, where the budget speech in 2025, far back as 2025, proposed that a level playing field should be brought to those local companies. For example, app developers, software developers in Sri Lanka are paying VAT at 18, SSCL at 20.5, but the big suppliers from outside Sri Lanka are getting away with no revenue taxes, because there is no business carried on here, and there is no taxable activity carried on here under VAT law. So now there's a deeming chapter that has come in and said, if you are meeting these conditions and you are servicing the Sri Lankan market from outside, you are also now liable to VAT, right, to level the playing field. So the bill was brought in April 1st, 2025, was challenged in Supreme Court, saying that they needed more time. Then the Supreme Court said you have to give minimum, at least it was agreed that 3 months should be given. And then October 1st, an amendment came, and it was supposed to be implemented from October 1st, but then again it was pushed it was pushed to July 1st, 2020. Sorry, it was pushed to October 1st, 2026. And then in March, a notice was issued again, pushing it again to July 1st, 2026. And now we have this amendment bill, which has changed the structure of it again. There's a new chapter now that has come in to replace the earlier amendment that was brought. So what are these amendments? If you look at the charging section, the yellow one was the old one that came in 2025, and the green wording is now it's saying that the tax shall be charged on the supply of services by a non-resident person through an electronic platform to a person in Sri Lanka with effect from July 1st, 2026. So the effective date is now July 1st, 2026. So who is liable? Right, it's a bit of a complicated area, so it needs, I think, even more deliberation, because there are some ambiguities as to how this will be imposed. So I'll just go through this very quickly for you. Non-resident person is only liable. So who is a non-resident person is also given in the law. Non-resident person undertakes service supply transactions occasionally or otherwise, acts as a principal or agent, has no fixed place of business in Sri Lanka, excludes persons registered under section 10, that is the normal registration section, so they are all excluded, and does not include those with an agent acting as per section 55. So basically, a non-resident person who undertakes service supply transaction occasionally or otherwise, and then all of the exclusions are given there. Then such person should provide these services through an electronic platform. So that's the next condition. You can't just provide services. You have to provide these services through what is called an electronic platform, which is defined. And that means any online system, website, mobile application, or other digital interface operating through internet that enables, this is the important part, that enables one or more service providers to supply services to service recipients. So it's an enabler. Your service, your digital interface must enable service providers to provide services to service recipients. Right? So it's not a very clear where I provide you software kind of and definition. It seems to be more complex than that. Right. Then the fourth one is you need to provide this to a person in Sri Lanka. Right? The consumption should technically happen here. So for that, you need to have a billing, residential or business address in Sri Lanka. The payment is made through a bank or financial institution. The payment instrument is issued in Sri Lanka. The IP address is located in Sri Lanka. Any two or more of the above criteria must be met for you to prove that it is to a person in Sri Lanka. And the last one is the non-resident must exceed the threshold, that is the new threshold of 36 million a year or 9 million per taxable period. So this is the sort of trajectory of how they are going to impose this tax. So the chargeability, the question is there a requirement to have three parties, like I just mentioned, a tripartite arrangement to be liable to digital VAT or not? Right? I think this has to come clearly from the policymaker. The law, to me, if you want to take a narrow definition, I think there should be a tripartite agreement, otherwise you're not liable. But an alternate interpretation is possible. So the first interpretation is that liability arises only when there is three distinct parties, that is the non-resident digital service provider, another service provider who uses the non-digital platform to provide services to recipients in Sri Lanka. This last point is the recipient has to be in Sri Lanka. The second interpretation is that you have two parties where the service provider in the definition of an electronic platform may refer to the non-resident person as per section 25. So non-resident person and the service provider are the same person, in which case the ramifications are I think more significant than the first interpretation. So this is something we need to get clarity on. Right, then the certificate of registration for the non-resident, it can be written or electronic, registered as a non-resident digital service provider. That's how the registration will go. He'll have his name, address, country of residence, effective date of registration to be included in the certificate, and the VAT registration number and any other details to identify the location of the person. Right. The next problem is what is the value of supply. Now, the bill refers to the normal section, section 5 of the VAT Act, as the value of supply. However, the previous gazette that was issued in the October, when they brought this in October, has a clear guideline on the value to be taken when supplying a digital services. Right. The non-resident supply value excludes, specifically in the gazette, it excludes the value of goods or services supplied by the original supplier. The gazette also assumes there is three parties, right, in the transaction. So the gazette notification clearly stipulates that the digital service provider has a certain value, and that is net of the value of the goods and services provided by the service suppliers using the platform. So these guidelines will need to be elaborated. Whether the gazette still is in force or whether an alternate will come is something we'll have to see, and I think also something we'll have to deliberate on with the policy maker. Right, so compliance requirements, payments and returns, there'll be a whole set of them for non-residents separately. And three types of exemptions: education services will be exempt, healthcare services will be exempt, and diplomatic and government services will also be exempt. So the exclusions from this and the sort of areas of concern would be, they have specifically removed B2B digital services, mostly excluded from VAT on digital services. What that means is if you have a VAT registration, and what it says is VAT on digital service will not be charged for supply of services made by a non-resident where the recipient of such service is a registered person under this act. Now, a registered person under this act is someone who is registered for normal VAT, right? Not for someone who is exempt, he is not a registered person, and not for someone who's registered under another chapter like registered under VAT on financial services. So they will not qualify technically as those registered under this act. So this indicates that some of the B2B transactions are excluded from digital services tax. However, those who are exempt, for example, those who are in the hospital sector, those who are generating electricity, are exempt. So they will not be excluded from this B2B exclusion. Further, those registered for VAT on financial services like banks and other institutions are also technically not registered, although they may have a VAT registration for other small services that they do. So on that basis, they should be able to take it. But then technically, if it was not excluded, they can't claim that input. Right? So there is a bit of a misnomer there, which I think the policymaker probably needs to go into it and make it more robust in terms of what is allowed and what is not. Right. Then the next one is this point of sales machine that was suggested in the budget is going to be mandatory for electronic transaction monitoring system. Right. So every registered person is going to be required to use secure point of sales machine for all transactions, including the issuance of invoices and maintenance of records for taxable activities. This requirement must be met within 3 months from the date prescribed by the authority. So it's not yet prescribed. So after the law comes into place, the Commission General will prescribe it. Once I think the systems are in place at the IRD as well, where RAMIs can accommodate this, it will be prescribed. And a secure point of sale machine is also defined as an electronic device or system approved by the CGIR. These machines must be capable of recording supplies, generating receipts, and capturing transaction data in real time. This is a measure to ensure accurate accounting of turnover and proper collection of remittance of that. So what I understand is there are some pilot projects going now for exporters, and the feedback is that it's very positive, where once it is matched, there is no need for significant record keeping. And there's a very minimal compliance burden and leakage as well. So I think once the pilot is done, they replicate it throughout, is likely to increase the compliance ease as well. So obviously there will be pros and cons of any sort of new scheme. The pros, of course, enhance tax compliance, accurate VAT reporting. The input and output will sort of tally. There won't be people who will exploit the system. Improves transparency and so on. And the cons, of course, is a high initial cost that is very likely. Technical challenges, training requirements are going to come in, privacy and security risks are going to be there, and the resistance of adoption, and of course, operational disruptions. Right, new offences and penalties. This was something highlighted in the Inland Revenue Act as well. New sort of penalties coming in. So for providing false information, failing to furnish required details, omitting required particulars in tax returns, submitting false returns, false documentation, incorrect registration, and so on. It was twice the amount of tax evaded or attempt to evade, and 25,000 fine and 6 months imprisonment. Now from October 1st, that's going to be increased to a 1 million fine and imprisonment up to 6 months or both. Then this is a new area where providing false or misleading information, concealing material tax obtained, but the concern is failing to furnish valid tax invoices and custom declaration also has been clubbed into this offense list, right? Failing to furnish valid, it doesn't talk about fraudulent or willful. So that is something of a concern, which is now criminalizing the failure to furnish a document, which I think needs to be submitted against. So there again, from October 1st, the fine is going to go up to 1 million rupees and imprisonment of 1 year or both. Right. So criminal proceedings also have been brought in, where the CJR is now empowered to investigate offences while the Attorney General or its delegate and shall prosecute offenders in the name of the CJR. So if a person is convicted of multiple offences arising from a single act, the maximum aggregate term of imprisonment shall not take. So they're putting a cap on the imprisonment for 5 years, and proceedings to commence within 12 years of the act or the failure to act. Right? However, in cases involving non-disclosure or misrepresentation, proceedings must start within 3 years of the date the correct tax liability is finally determined. Publication of taxpayer information for transparency. They are going to be to ensure, the CJI now authorized to publish names and addresses of taxation of any registered person along with their current status of their registration, to encourage compliance. I'm assuming new exemptions that have come in applies to businesses of strategic importance under the Port City Commission law. Has also been is going to be enacted to exempt them. That was there initially. There was a disconnect between the VAT law and the Port City law. So that amendment is coming, and this new exemption is going to come into force. Other provisions, entertainment tax is something that they're going to remove from the value of supply. So there is entertainment tax on paid. So when paying VAT, they will exclude the entertainment tax from the value of supply for exhibitors. And the zero rating, a new zero rating, will be eligible for this 45-day refund. Sorry, is for services provided by a registered garment buying office to overseas buyers for payment in foreign currency. Are recognized under specific conditions effective from October 2025. Is considered to be zero rated under Section 7. Then write-offs, provisions have been made to write off tax in default for specific government undertaken tsunami relief projects by the CJI. The total cost, tax cost to the government will be written off. Now, social security contribution levy is a small area. I'll quickly take you through it. Here again, just like in VAT, the thresholds are coming down from 15 to 9 per quarter and from 60 million to 36 million per annum. Right. So the threshold test, if aggregate turnover exceeds or is likely to exceed 9 million in a quarter, starting from July 1st to September 30th, or any subsequent quarter, the obligation to register, the taxpayer must apply for SSCL registration within 15 days from the date the threshold is exceeded or expected to be exceeded. Commencement of liability, once registered, the person is liable for SSCL on taxable turnover from that same quarter onwards, not from the date of registration, it's for the quarter. So I'll just skip this. The next change is on motor vehicles. So what is liable to SSCL is now it is imposed on the import of motor vehicles, and what is exempt from SSCL is now the local sale with effect from May 1st, 2026. So the sale is now exempt, and they're trapping everyone at the import point because the traders were not, the argument was difficult to control it at trade level. Some were paying, some were not paying. So they made it exempt at trade level, and they are now imposing it on import level so that at import point, everybody gets caught. Right, so those are the changes on both VAT and SSCL. I'll hand it over back to Mr. Gajendra.
Thank you, Mr. Sulaiman, for your detailed presentation. I'm sure there are a few questions which we will take it up during the question and answer sessions. Now, moving on, the next item of the agenda is the Supreme Court determination with regard to the Inland Revenue Act Bill 2026. Principal Tax and Regulatory at KPMG, Mr. Suresh Pereira. Over to you, sir.
Thank you, Mr. Gajendran. I'm audible, I believe.
Yes.
Right, yeah. So I'll take only a few minutes. I'm not going to go into details, just to give an idea with regard to this Supreme Court case and what it is. The background is, as you all know, according to our constitution, for an act to be passed in the parliament, first it should be approved by the cabinet, and once it is approved, it should be published in the Gazette. And once it is placed in the order paper of the parliament, I think that's 2 weeks or 14 days. Within that period, anyone who interested can go to the Supreme Court challenging the matter in relation to the constitutionality, not in relation to how to say, a broader spectrum of grounds. It's only the constitutionality the Supreme Court is permitted to look into. And so on that basis, like many other bills in the past also, this was challenged in the Supreme Court. So as we all know, when this bill was published, we did see the approach or some of the strict provisions that were in this, and these provisions were subject to much talk, or let's how to say, debate with regard to the appropriateness of these provisions. And in light of that, Attorney General's representative pointed out at the Supreme Court that 5 provisions in the bill were to be taken out, to be removed due to a cabinet decision. So I think Mr. Atul Samaravir also alluded to these issues, but I'll go a little bit detail into these ones, right? So as we find out, as we all know, basically there were 5 petitions that were filed, and 3 petitioners withdrew on the undertaking given by the Attorney General that 5 of the, how to say, 3 out of the 5, 3 were in relation to the objected clauses in the bill, and they were withdrew. So what are those clauses? The first one, like Mr. Atul Samaravir pointed out, is in relation to the thin capitalization. As you all know, Section 18 of the Inland Revenue Act, the short title is limitation of the financial cost, so what we call colloquially as the thin capitalization rule. And in relation, there's a formula given, and according to this, anything over and above this formula, the interest amount that we are paying, not just to a related party, even to a third party, cannot be deducted. That's the harsh or the very strict rule formula that we find in the Section 18. So we have had much debate with the Inland Revenue Department with regard to the interpretation and the application of this formula. In this formula, there is a variable called reserves. So now, what is the definition of the reserves? Now, as all the accountants are aware, this concept of reserves, when we look at, we use as possible. When we have profits, we call it positive reserves, and when we don't have the reserves, we call it negative reserves. So the issue was, into this formula, are we going to include this negative numbers when the reserves are not there, or are we just going to put 0? So department has been taking up the position that negative amounts should also be included in calculating this one, because that results in a result that is favorable to the Inland Revenue Department, which is unfavorable to the taxpayer. In other words, taxpayer cannot deduct the amount of the interest to be deducted is getting curtailed when this amount is put as the reserve amount is stated as negative amount. So basically, when you don't have reserves, what we call the net negative reserves, that results in eroding the stated capital also, because you add the stated capital to the reserves and into 4 times is the formula. So when you substitute a 0 figure, negative figure into the reserves, that results in a lower amount of deduction of the interest. So this has been the practice of the Inland Revenue Department, and somewhere in 2023, there was a judgment that was given by the Court of Appeal. Like Mr. Atul Samaravir pointed out, in relation to the in the case of Samson Rajarata case. And there, the court, having considered many things, gave the opinion that in the formula, the reserves figure should always be positive. If the company has no positive reserves, then it should be substituted with 0 and not a negative figure. So decision that was pronounced by the Court of Appeal in the case of Samson Rajarata was in favor of the taxpayers. So what happened at the end of that case, the Inland Revenue Department, as we all know, according to the procedure, if you fail a case in the Court of Appeal, you do have the opportunity to go to the Supreme Court. So how do you go to the Supreme Court? You have to request for leave to appeal from the Supreme Court, and then if the leave granted, then the matter could be decided by the Supreme Court after hearing the both parties. So now here, Inland Revenue Department followed a very peculiar strategy. Normally, when you fail a case, lose a case in the Court of Appeal, Inland Revenue Department always appeals to the Supreme Court. But here, they did not do that thing. They did not even request for leave to appeal. They straight away moved out from the court system, and they decided to amend the law to overcome the judgment. So as a result of that, this was in the budget proposals also, and they amended in the Inland Revenue Bill, they came up with a new formula to overturn the judgment given by the Court of Appeal. So this matter was, I think, harshly criticized by the stakeholders, and so the cabinet decided not to pursue this new amendment to overturn the result given by the pronouncement made by the Court of Appeal. So actually, it's a welcome move, and I think we should actually praise the government for that, because government did listen to the stakeholder objections and decided not to pursue that one. So this matter was not taken up in the Court of Appeal for the hearing, because there was no necessity to do that thing. So that's point number one. Then, in addition to that, in relation to the insurance industry, the bill had originally 3 amendments. So out of the 3 amendments, only the amendment introduced by the 52A, that is basically the exemption, specific exemption in relation to the claims received in relation to the life policies. The claim either received by the life policy holder or the the beneficiary who receives upon the death of the life policy holder, to ensure the life policy claims are to be exempt from income tax in Sri Lanka. So upon the maturity, death, or surrender of the policy, when the claims are being paid, either in the hands of the life policy holder himself or the beneficiary, they are not liable for income tax. Now, this is an interesting amendment. Why? Nobody in Sri Lanka actually paid taxes in relation to the life policy claims, and Inland Revenue Department also did not raise assessment. But nevertheless, there was no specific exemption in the third schedule of the Inland Revenue. So when there's when there's no specific exemption, that means when you receive a claim, you have to test for the taxability. Though there was no taxes paid, there was a question mark in relation to this. So the Inland Revenue Department, how the policymakers have eliminated that doubt by introducing Section 52A of the bill at that time to ensure that it's not open for debate anymore now. But there were 2 other sections in relation to the insurance industry. The ascertainment of the tax liability of life assurance companies, formula to be changed. There was a proposal, and that was taken out. And in addition to that, there was another provision to provide, to empower the Commissioner General to come up with tax adjustments in relation to the life insurance policies in the context of the SLFRS 17, that is the accounting standard changes. Now that, of course, it was also taken out because it amounted to Parliament delegating powers of legislation, power to make laws, to a bureaucratic officer, that is the Commissioner General. So that is not within our constitution. That's a violation of the constitution. And having understood that, the cabinet decided not to go with that also. So that was also removed. But at the same, while we welcome the removal of that clause empowering the Commissioner General to make laws in the country, according to Article 148 of the Constitution, it's only the Parliament that has the power to make laws in the country, and it cannot be delegated to, that power cannot be delegated to a bureaucratic officer. So that while we welcome that removal of that provision from the Inland Revenue Bill, we also point out there is a issue to be resolved in Sri Lanka. Yes, there's a SLFRS 17 coming in, and this requires relooking to how the tax laws should be adjusted. That has to be done according to the correct procedure. So what is that correct procedure? There has to be a committee probably appointed by the Parliament, and that committee should give the recommendations to the Parliament, to the Minister, and that should go through the Parliament itself. Those amendments should go to the Parliament, and that should be introduced. So I think in relation to this point, now the policymakers cannot keep silent or be inactive. They have to act in relation to this one, while we welcome the removal of that power given to the Commissioner General, which is not in accordance with the Constitution. So in addition to that, there were two other, there was that other specific important one, that is the power to, evidence being barred. There was a specific formula given, there's a time period given. Within that time period, if those evidence that has not been admitted, produced, and there was a move to prevent those evidence being introduced at a later stage. That is was an amendment to, that was an introduction of a new section to the section 122 as 88. So that was also taken out. So those three critical amendments that were in the bill were taken out without proceeding for hearing at the Supreme Court. So I think again I want to repeat, we need to give our gratitude or the positive feedback that it's a very good move to from the point of view of the government, that it was not that it did not pursue those three harsh amendments to the bill. So in addition to that, there were two others also in relation to the residency, investor residency visa, and also with regard to something else also basically. So that's basically the major thing that happened before going to the before moving to the hearing stage of the petition. Now, what did happen at the hearing, and what was the determination? Now, two things then went up for the contention or for the arguments. First one, with regard to the section 185A, a new section, new chapter, section 17A, and a new section 185A was introduced into the bill to criminalize certain 5 administrative activities, including obtaining a TIN, filing a return, filing a capital gains tax return, when summoned by the IRD officers to be present physically at the Inland Revenue Department. And in relation to those 5 activities, failure to comply with, after giving 30 days notice, there was power given to the Commissioner General to issue such Commissioner to move to the magistrate court directly for 4 lakhs, up to 4 lakhs of maximum punishment, or up to 6 months imprisonment. Now that clause was not cancelled or basically vitiated by the Supreme Court. Supreme Court said that section is perfectly constitutional. So we do find that section in the amended Inland Revenue Act. So what we have to keep in mind is, now in Sri Lanka, if you don't have a TIN and you have been given notice by the Commissioner General, 30-day notice, and you don't comply, you can end up in jail for 6 months or up to 4 lakhs penalty. So this is basically a very strict move to strengthen the administrative powers of the tax administration of the country, and so we have to keep this laws in our mind when we are going about in Sri Lanka now. So the second one was in relation to, again, there was a new section introduced to the section 163, 4A to 4H new sections introduced. This is basically what we call the certificate procedure, summary procedure. Commission General has been given powers to issue a certificate with regard to the taxes in default and collect these taxes in default by issuing the certificate to the magistrate court. And then this amount is considered as a fine imposed by the magistrate court. And if this fine is not paid, that under civil procedure court, this could result in the person being imprisoned also. So again, we have to keep in mind a criminalization, or basically where you will be ending in jail, can happen under this new provision. So there are two very strict procedures that have been introduced to the Inland Revenue Act, and the Supreme Court has endorsed these two new measures, and Supreme Court has clearly said that these two measures are in accordance with the Constitution and there is no violation of the Constitution. So this is something that we have to keep in mind. So by giving these powers, the Commission General has very broad, very wide powers to administer or to collect taxes in Sri Lanka. So in a nutshell, I think that's the decision of the Supreme Court that was delivered to the Speaker in relation to the bill that was challenged in the Supreme Court. So just to summarize, though there were many issues in the bill that was objected, 5 petitioners went to court, 3 petitioners withdrew their petitions because five issues were withdrawn by the cabinet before the matter went up for hearing, and 2 matters, section 195A and section 163 4A to 4H, were the matters that were contested in the Supreme Court, heard in the Supreme Court, and the Supreme Court gave the determination that they are constitutional. And we do find those 2 sections in the bill that was passed in the Parliament as the Amendment Act. So in a nutshell, that's what I want to say, Mr. Gajendra.
Thank you, Mr. Suresh Pereira, for your detailed presentation. Next, we will move to Mr. N.R. Gajendran, Senior Partner at Gashma & Company, to explain about the impact on economy of these tax changes. Over to you, sir.
Thank you, Gajendran. We are coming to the real point in issue and debate for Sri Lanka, the economy. We have stabilized the economy, whether we are going to recover and whether we are going to grow. The question that has been asked everywhere, where is the growth? Where is the investment, particularly the foreign direct investments? There have been so many discussions and debates, even in the papers, and everyone is giving their views. Now, we can have all these changes in law, and we can justify the changes. But are the investors, leave aside the SMEs who have been badly targeted, the SMEs are basically from Sri Lanka. Even the foreigners, some of them are SMEs. But there are whether large investments, whether this is a darling for investors, should have been the darling for investors, Sri Lanka, which is far from that. Why is that happening? There can be institutional factors. There can be policy missteps, like even in today's papers, they have been pronounced in one of the papers front page. They are saying about the National Export Development Plan 5-year, and they have spelled out what is going to be planned and what is going to be said. They are talking about digitalization. They are talking of labor reforms. One thing they are not mentioned, I didn't see, is about this land unbundling of land, because almost 85% of the land owned by the government. With all that, if you see I think one of the multilateral agencies has mentioned the most important thing is going to be the implementation. Now, if you ask, when you speak to investors, particularly the foreign investors, the question of whether Sri Lanka can be trusted. And that is a very fundamental question that comes directly or indirectly. And I can give you two reasons on that. Without mentioning name, if the government enters into a contract with a foreign party, and when there is a change of government, you vitiate the contract. Do you think the foreigners thereafter will have confidence in the country? Unless we have a major damage control system to explain and expound, and that is impressive to the foreigners. You can't say one government made a mistake, lack governance, were not up to the mark in corruption. So we are coming and redoing. That's not going to happen. And then what happens is, even the port city law, they gave something law of a 2-year period for early bird registration for people. They approved for 16 or 15 or 17 companies, the secondary business status. And thereafter, they stopped the others. Maybe because of multilateral pressure or whatever it is, but that went a wrong signal. Because there are people who got the secondary business approval, tax only deductions they got, because they are not sure what will the state's position will be in future if there is a change of government or not. Even the same government can retract what they have done. That is the fear. So this has to be focused, because if you see when the Gulf area was under attack, many head officers, many regional officers who had bases in the Gulf countries were fleeing that country. And Sri Lanka should have been an ideal place with the port city law and the other laws that it have been. But we have not attracted the people. There may be a few people who may have looked at it, but there is no story of a big of major investors coming into the country. Now, apart from this, if you see this law, I think Sulaiman mentioned the word criminalization somewhere when he mentioned. This is the first time I am seeing where there is last 40 or 45 years, there are criminal provisions in the law where people can be penalized and can be incarcerated under both all the tax statutes. That is nothing new. But there is an intensified effort to criminalize even for mediocre small offenses. Now, the question is whether policymakers at the top is aware of this. And if it is not aware of it, then who is doing this work, and whether it is in the interest? Because nowadays investors, particularly foreign investors, they are now well informed of the developments of the countries. They use generative AI. Apart from that, they have a research team to study what are the developments in the country. If you go for international deliberations, congresses, and in conferences, in the corridors, people ask questions. Sometimes you are ashamed what the questions are being asked. So here are provisions which have been criminalized. And if you see, as Suresh clearly explained, they brought in provisions and removed provision. Now, one of the multilateral speakers in the paper, today's paper, says it is all on the implementation, where the policy is saying something that case laws have said that's almost the same thing, but the administration is going in a different way. I'll give you this as a thin capitalization rule, which was withdrawn. right? They wanted to bring in the negative reserves as a part of including the calculation of the capital, right, into picture. First of all, there is a mismatch of the terminology of issued share capital and stated capital. In the Companies Act, doesn't talk of issued share capital any further. Companies Act doesn't talk of reserves definitions any further. It talks only about stated capital. But we are still talking of share capital in our laws, in the tax laws and reserves. That complication is there. Because of that, otherwise, now courts decided in the Raja Rattare case, there is nothing called negative reserve. Reserve is the reserve. Is undistributed profits is the reserve. There is nothing as negative reserves, right? So that was the case. But the Department of the Inland Revenue was saying that is under the old act. This is under the new act. They had a different view. Now, when this has been deliberately brought in because of the Raja Rattare case, as the way who Atula mentioned, here the policymakers are saying, no, we don't want to do that. We want to go by the case. But even now, I think the administration doesn't want to look at the other cases which they have taken up these matters even now. Not the future they won't do, but up to now they are not going to release those cases because they want to go with the test it to see whether this law, the new law, is different from the old law, right? There may be merit in that because of this mismatch in the definitions used to mismatch in the definition used. There may be this thing in that, but the policy has clearly laid down. The courts have clearly laid down, but still we are having an issue. So that is one thing, The second one is, if you see where the criminalization was going through in the Inland Revenue Act, it was also mentioned. I think Suresh also mentioned this was withdrawn. 6 months, where if you don't give information within 6 months, or for the foreigner 9 months, that information you can't give it later and inadmissible. That would have been a far-reaching thing, and the policymakers may have not been aware. That's the reason when it was brought in, they withdrew it. Who is bringing this? Why are they bringing this? Is it good for investment? Will people have trust? Now, if 6 months, there is one principle of natural justice, is odd alteram partem. That is rule, that is, you should be heard, taxpayer. Here you are denying the taxpayer of being heard for the right to appeal and all that, right? Because of that, for whatever it is, for good reasons, it was removed. For bad reason, it was brought in, and that is not appearing now. If it has gone through, it would have a major effect on the investments. So if you see even section 163, right, there again, the Commissioner General in the bill was given almost omnipotent power, supernatural power, where even the magistrate can't question whether it has been duly assessed or where he could have not been questioned the correctness of the assessment. The courts rightly said, look here, or if it's administrative reviews on, then you can't. But here again, when the Commissioner General's feels there is tax due, right? Tax due also has to be established. But they say, Fred, he'll file a certificate. Magistrate can ask him to show cause why action should not be taken. If he doesn't show cause, reasonable cause, then it gets deemed to be a default. But magistrate, when he asks him to show cause, on the other side, it is said, this notice cannot be questioned. So how can a taxpayer show cause when the notice cannot be questioned? So, but I don't think that should be permitted. Taxpayer should say why. So there are instances because the collection record is wonky and is all misleading. It went into debate in Parliament. Now no one speaks about it. Outstanding was some almost 900 billion. Most of those numbers were inaccurate, incomplete. Some taxes have been paid and not given. So the recovery officer looks at the screen and takes the amount and gives the certificate. That account cannot be questioned because I have already paid the tax. It can be, but that so to that extent, they were trying to bring the criminalization, and you are penalized. And even if you this thing, you are given only postponement also 1 month, nothing more than that. It's still there. Draconian provisions are there. Some officers say, senior respected officers on the inland, these are only there for not to be enforced. But that's not the point. One officer can make a decision to enforce one of these things. No one can stop him, because he cannot be stopped him, because even the superior tells, he will say, no, I can do it, you can't stop it. And once you put the case, they will never withdraw the case. Then even if you see the more far-reaching thing is, as Suresh said, that new chapter is included in 185A, where you don't file your APIT statement or employee statement, or you don't file a return, or you fail to open a tin or appear before the commissioner. Now, tin, if you see, so the way it is being spoken about, which I don't think is in line with the law, under 102, they are saying everyone over 18 years should have a tin. If 15 million people are over 118 years, are you thinking all of them are going to have a tin? If they don't have a tin, the CRJ can serve a notice, and he has to show, the person has to show reasonable cause. And if it is the Commissioner General not after summary trial, he can be imprisoned for not opening a tin. But the courts, the impression, the courts, what I got from this thing of the court's impression is, you don't criminalize straight away. You don't take a person and imprison him straight away. He has to be an habitual default. He has to be an habitual default, or he has to impede. Now, if you see, there is already in our law provisions in the Inland Revenue Act about from 186 to about 190 and 90A, where these are criminal offenses. Punishment is there for imprisonment. Even section 190 says, if you don't file a return, there are a whole heap of things, including filing a return is not there, and also not opening a file. I don't know whether it is there. It's a whole heap of things. And if it impedes administration, that's a very important word, impedes administration, you're obstructing administration, then you can take criminal action. Now, if a small offense like this, nothing is stopping the Commissioner General to take action, and he can be fined 400,000, or he can be imprisoned for 2 years. Now, this is not happening not only in the Inland Revenue Act. If you see it happens to the VAT Act also. That is what I am saying is intensity. Someone is bringing this. I don't know whether VAT Act, no one revisited it because maybe people, it's costly matter to revisit this in the courts. Even filing papers, all that is a costly matter. So it's a process, and people should be ready to come forward. I think one of the few chartered accountants only this time went to courts for the Inland Revenue Bill. No one went on the VAT bill. If you see section 66, there again 66, 67, 68, already these fraud provisions are there. If you make a fraudulent refund claim, right, twice the amount as take one, there is no problem. If there a fraudulent refund claim is made, then you can penalize guy, there is no issue. But the way it is drafted, the way I read it, the taxpayer is exonerated. It is the person who's assisting the taxpayer, he is being burdened. This thing I don't think is intended, but that is the way it has come. And if you see the same offense in the section 66, what is mentioned for fraudulent refund, it is also been caught up in section 67, that is within pertaining to returns, making fraudulent returns. So you are bringing both, the same offense is penalized to it. Generally, you can't charge a person for the same act for twice over, right? And that is also provided in the law, right? Penal provision is, it is there. That is something that has to be looked into. Then section 67, again, failure to furnish return, and I think I mentioned about the refund. Other one is to failure to furnish VAT invoices. I think Sulaiman mentioned it. If you don't give the VAT invoice, you don't give input credit. That's all. If you don't give the VAT invoice, you don't give the input credit. There is no fraud here involved. So I think the chamber also has taken this matter. I believe that it will be, I hope the authorities will take care. If there is no VAT invoice, don't give the credit. What is there to take the guy to courts? You won't give the credit, and why do you want to pay imprisonment or ask him a fine? It doesn't mean anything. Then if you see 68, there is the maximum imprisonment is 5 years, which is already there. But they say under this chapter 12, 66 and 67, the imprisonment is only 6 months. So the maximum imprisonment should be 1 year. There is no way 5 years can come in here. Even earlier it was happening, they have reproduced the thing. And there's another thing which is already in the inland revenue, there say proceedings to commence within 12 years. So if there you have acted on in a particular way, and that is criminal, and if you have not acted in a particular way, that is also criminal offense. The action can be taken by you after up to 12 years. Now you take a person who's expected to keep the records only for 5 years. Now when you 12 years, it looks awfully long period. So we have to we have to, if we want to promote investment, we had to go and showcase our laws, which proactive laws, giving the taxpayer a good chance to function, to invest, to do business, and to exit. Friends, so this is something that taxpayers don't realize, but the day one person gets affected, only we will realize, and hopefully, like some of the senior officers are saying, these are not going to be implemented. But if, it's also irony that professionals are speaking of this, because if you ask me, the professionals in this field who are practicing are beneficiary of these provisions, because there will be issues arising. But that's not the way forward. I think even on the investment side, I must mention another thing. The cost-reflective investments is important. This is where I think CMA's role is coming as costing, where you have to cost records and cost stand. So now our petroleum prices, our power prices, it's all cost reflecting. Do the government, this institution, where the people, do they know what the cost is? First of all, to have a cost reflective price. That's the reason when the cost reflective price also you have a loss, Lakshman, and with the cost reflective price also you have a profit, So there, I think you have to give a lecture to these guys on this costing, So we have to see, the very important is we have to get the investors, particularly the foreign investors. We can't say, look here, we are, our governance is improved, all that is there. You have to impress what the foreigners will get impressed. They should be comfortable. First, they have to trust whether you can do this. What we say, we mean, and mean what we say. Thank you.
Thank you, Mr. Nagendran. Now we'll move to the question and answer session very quickly. I can see most of the questions has been already answered by Mr. Atula Ranavira. So there are a few remaining questions. I think if anybody want to take up a question, directly can quickly send us question to the question. Over to you, Professor.
Yeah, I think there are some questions. No, I would like to go through that. Or there are some questions.
Yeah, one of the question is, I think there are 3 or 4 times is repeated. Yeah, capital gain tax on share trading. Yeah, there's a one question I think. There's one question is repeated 4 or 5 times. One is the capital gain tax on share transfer by a trust on a listed company shares. Is it liable to a new tax rate of 30%?
Listed company shares are not liable.
Can you hear me?
Listed company shares are not liable, Gajendra.
So that's
And the
subject to the
third
share
schedule,
transfer
it is
levy.
exempted.
New tax rate of 30%. That was capital gains, no? There is no capital gains tax. That's what they are
Because
asking.
subject to share transfer levy. Then there's a question about this specified tax invoice format layout. Any of the presenters can give idea on that?
New tax invoice layout came out before, if no one is mentioning. I think this is Sulaiman's topic on the VAT.
Yeah, the layout, I think the last we made some submissions through various institutions and it was changed. So the new layout is now in force. It was gazetted or at least issued as a format that has to be followed. So there are various attributes in it that have to be followed. Is there a specific question they're asking on that? Or?
Because I think Sulaiman, permit me to say this, with the deliberations made with the institute and with the chambers, the Inland Revenue was proactive in this matter, and they gave the hearing, our hearing, they gave us a good hearing, and they have corrected or amended the earlier gazette, and they deferred it, and they have already corrected. If there are any particular concerns on it, we can see, we can take it. But I think most of the issues have been addressed. If you, I don't know, unless you have a different view, Sulaiman. Most of the issues.
You're right. Yes, exactly. Yeah.
So those are the questions which was there on that
Right.
question and answer session, which was not answered already.
There is one here where your tax act is very harsh on taxpayers. Why is not so on tax consultants and auditors who are also part of crime at times?
If anyone is making a crime or evading or aiding and abetting to evade the taxes, they are now brought in.
All are implicated.
Yeah.
All are there. All are there. All are there. But I think most of the, I must mention also the professionals, and it can be employees. Some of these perpetrators of this fraud, they are not doing it in public. They do it in private. Even the employees may not know, right? Even the consultants will not know. Unless the consultant or the employees are directly involved in the fraud, this aiding and abetting or assisting can be also misconstrued. You won't know. I'll give you a simple example. A company gives you a fraudulent tax invoice. Job of the taxpayer or the consultant is to follow on the input credit and to get the refund, right? I think this is coming after these export refunds are being made, and this is a protection that is given to the revenue, that so that to bring in the consultant, that is okay. But if you follow up on the input invoices, you don't know whether this is fraud or fake, right? You really don't know. You see the tax invoice as a consultant. What you see, you will see tax invoice whether it's in law with the law, right? So if you are in with the law wording, you will follow up. Now whether this can be assisting the fraud or this thing is another issue, I don't think so, right? But at the same time, to clap, you need two hands. These frauds at the Inland Revenue can't take place without the connivance of the Inland Revenue officers. So now they have to have, they have to be also penalized. But the way others have been taxpayers are penalized, and this thing, they also have to be penalized. So I think that is something that has to come if you want to prevent all this malpractice and fraud and evasion, which is the case. Sulaiman, you want to add anything?
No, I think you summed it up well.
Right. Gajendra, anything else? That's all.
So there's a one question.
You are talking to Gajendra, no Gajendra?
First Gajendra, then Gajendra.
When you said
No
Gajendra,
problem.
oh,
Both are in the
Gajendra.
same profession.
Uh,
Both are in same profession. No problem.
right.
So
So I
there's a
think
question on the deemed VAT credit for the stocks held on 31st March 25. Now these amendments are giving as a rebate for the stock at 30th June 2026. How to navigate the VAT issue on this old stock?
Yeah, so old stock, there's a provision to give this deemed VAT. There'll be, I think, a backward calculation. There will be a guidance issued by Commissioner General on what are the conditions that you have to have. Basically, a format you need to know when you bought it with supporting documents. And the VAT applicable at that date will be, I think, inward calculated, and you will get a credit against it when you sell. That is, the prescription has to come, but I'm assuming it will be something like that.
This is it's a relief provision for the SMEs, but SMEs are really hit on this because when you say 36 million rupees a year, it's 3 million rupees a month. That is 100,000 rupees a day.
Yeah.
Right? 100,000 rupees sales a day. If an SME sells 100,000 rupees a day, will he have 10% margin, 15% margin? And if a small guy doing 100,000 rupees a day, if he gets 5,000 or 10,000, that's the amount that he needs for living, right? He will need that margin for living. Otherwise, he can't live if he's doing a small business. Now, if you take 18, 20% off or 20% off with the SSCL, he has to jack up the price. So what will happen is there will be silent evaders. They are not going to pay this tax. When the tax is prohibitive and unbearable, even the governments can go into a problem. But this is going to be a huge problem. If you are going to enforce this, so many people will come. It's nice to talk this thing. I think Sulaiman also mentioned earlier it was 12 million. Then it was even if you get that pricing in now, that 12 million tax-free allowance, it must be 120 million now with the way the prices have gone up and things have gone. So 36 million is nothing, So if you want people to be compliant, they should be able to afford to pay these compliant taxes. Otherwise, this compliance by force is not going to happen. There is another nice article written by someone in the papers today. The compliance can't be forced. You have to volunteer compliance, and what the other countries have done to improve compliance is something. You can't bring this laws like this. How can he pay? If 100,000 rupees a day, what tax can he pay? He can't pay any tax. So
are you saying
the relief
the price
provision
will have to go up? Price will go up or what?
No, the price is determined by the market. So if there are 10 players, one fellow try to increase, he'll go out of the business. Others won't do it because most of them are informal operators. So how can you do that? So if a guy wants to genuinely pay, he can't pay because there is no level playing field, right? And they will go and even if there's a field survey or happening, nothing happens end of the day.
Thank you for all the resource personnel for your valuable input. And if you have any further question, please send them to the CMA Secretariat. Now I hand over to Professor Lakshmana Vattavala for the concluding remarks.
So I must thank all our speakers, especially I think going through all the very important details that are there, but only I was very worried on the last comment made by Mr. Gajendran, because he said that, especially the SME, because I think our main area here is on SMEs, whether now, if the price cannot be adjusted, do you think that that sort of situation will come up, or what would really happen in the market? That is, people will maybe not maintaining books of accounts or uh, thing, but now whether they will bring this other thing about now QR payments are coming in, which means that they must have a bank account. Now, will those things happen, or people will avoid this and then go on to maybe all cash basis? What do you think is going to really happen?
At the moment, if you're asking me, Lakshman, at the moment, they will go on cash basis. When the QR code comes, it can be mandatory, and people, sometimes they will say, look here, even now they say, cash is so much. If you are paying check or bank transfer, it's so much. People say, right?
Mhm.
But I must tell you, this QR code, this what happened in India. They embrace technologies, SMEs, street, this thing. And what happened is they collected money through the system. Pay fast, what is it? They have a name, no? Pay fast or something, that system.
Yeah.
And they
pay,
sorry?
you pay, they have 3-4 system on that. You
Yeah,
pay.
yes. Yeah, continue. What do you say? What are the 3-4 system? So,
PayPal.
yeah, PayPal. Yeah, correct. And they didn't pay the tax. They didn't pay or pay underpaid. Then what happened is, because the system was there, the government was able to raise about 800 billion Indian rupees on that. Because when the system is captured and the bank is captured, you can't very difficult to escape. So that can happen. Then the prices will go, and again these markets will go. The end of the day, what will happen is the larger businesses, I always will benefit, because some smaller ones will get,
This
they are unable,
competition.
they get shut out because they can't meet this, right? Meet this thing. And you can see, even this nowadays, there are still eating houses. If you go around Colombo, they don't charge VAT because it's 60 million. Now, I don't know whether all these eating houses will, because definitely they will have to charge VAT if that is 3 million. If they charge VAT, then the prices goes up. Then the people can't afford to eat also, small. So there is a question now. It's, it has to be, any tax has to be affordable. Otherwise, it's going to be a problem.
And maybe a gradual, it will happen. It won't happen automatically, but as you say, maybe over a period of time,
End of
you
the day,
might see.
prices will go up. End of the day,
Yeah.
prices will go up. If all of this paper play, straight away 20% will go up.
Anyway, we have to think about the affordability also, disposable ability. Now, day by day, the affordability comes down. As a result, ultimate result may be less savings, less investment, less economic development.
Exactly.
We have to think about that also.
Suresh, any comments from your side? I don't know if the Suresh is there or is.
Yeah, so basically, I think as a concluding remark, what I want to point out is Sri Lankan system, the tax framework with regard to the administration, the compliance is being tightened. And this, okay, it's a positive side from the point of the government to ensure basically all taxpayers are paying taxes, broadening the tax base, etc. At the same time, we have to keep in mind why this is happening. There are stiff targets, and if you look at the last IMF report, it has been pointed out. I think 2.7 trillion was the target given, but Inland Department achieved 3.56 trillion by way of taxes. So they exceeded the target given also. So you can see there is the tax collection is taking place very efficiently. So on paper, it's a very good thing. And from the point of view of the economy, from the point of the government, etc., it's a positive thing. But also we have to keep in mind when this kind of aggressive tax collection taking place, there is a tendency to undermine the rights of the taxpayers also. So this is where I have been advocating that we need to have a tax ombudsman. So when there are grievances, there are enough and more taxpayers who can't afford the lawyers to go to courts. So there should be a forum where they can go and ask redress. So I would, while the aggressive tax collection framework is taking place, while the aggressive tax collection is also taking place, that we need to have the Office of Tax Ombudsman re-established. This is the important point, I think, in this environment. Because we need to look at the rights of the taxpayers also.
Actually, on the increase on the income, is it due to maybe the salaried employees or the business? What is the increase percentage-wise when you take up?
Percentage, it's not the increase, it's basically target versus the actual collection.
Yeah.
According to IMF, it's at 2.7 trillion. I think the actual collection is 3.56. So I expect, because of this drive that is taking place now, strengthening the laws as well as the efficiency, I think during the last 2-3 weeks, we may have heard many taxpayers pointing out them receiving notices, SMSs, etc. So you can see there's a, how do I say, renewed effort from the IRD officers also to go after the tax defaulters, which is a good thing. But at the same time, there could be cases where when this kind of aggressive tax collection taking place, rights of the taxpayers are also being curtailed. So we need a forum here to look after them also. So both should go parallel. So we can't curtail the rights of the taxpayers and create a situation where they don't have a forum to go, where you say that, okay, you go to courts if you have a problem. No, not that kind of things. That's where basically I advocate that we need to have the tax ombudsman office being re-established.
Suresh, your tax ombudsman office is a very good thing. It doesn't mean that we didn't have the tax ombudsman before. We had it twice over. Paranagama also was, Justice Paranagama was, I think, was one time panel, and he was a one-man show. If you are going to have a proper tax ombudsman, you must have an army of people. And also you are going to have, you have to give them the legal teeth. You know, if even in the past experience, the way I have understood this, anything the ombudsman said, the revenue ignored. There was no legal compulsion to follow that this thing, and it's died away. It happened twice, I think, the ombudsman.
No, correct. That is because at that time, I think it was in 2011 thereabout, the tax ombudsman office was created by a cabinet paper. There was no constitution. So basically, when the tax ombudsman being established, it should be done by way of an act of parliament. So at the same time, as you rightly pointed out, yes, tax ombudsman should be given legal powers as well. Not just to send a letter to the Commissioner General pointing out, but legal power for him to order the Commissioner General to execute a particular activity.
So, are you following up on that matter, or anything is happening on that matter on the tax?
Well, this matter I think came to into budget proposals 2 times in the recent past, but unfortunately, it is not being implemented.
Right. Right. Okay. So anyway, let me thank all our speakers and of course our moderator also for the excellent manner in which the session was handled, the recent changes that have taken place and implications that will be there. I think these have been taken up in different forums, and also CMA were happy. I must thank all of you all for readily agreeing, not only this time, but many times that you all have come and supported us, and also the large number who have benefited from these tax webinars. So let me thank you because as I said earlier, the many things that we have also taken up on the cost accounting standards that we are now hoping to do. Let us see how maybe we can show how the cost would be affected as a result of taxes also. Of course, it will be the direct VAT and other taxes that will go into it. So this might be something, Gajir, you might be able to help us how maybe the cost also could be affected as a result of the taxation, which might be something, because what we have this what is called the societal cost, and of course ultimate the price that will have to be paid by the consumer. So that's what we are also looking at. So once again, let me thank all of you all, and also our moderator is also Gajendra is our chairman of the tax committee, and he might also be able to coordinate with you all and take up any matter that you all will also need support, and also to give any support to the tax committee of CMA to take up any matters now that the budget is coming up. You all can also give certain suggestions which we can take up with the finance ministry and ask them to include in the budget. So thank you, and also to thank all the participants who were there. I think there were about 270 or 275 participants. Currently, I think a lot of them have all taken leave, but I'm sure that they have all benefited, and that will also be there, as Atul mentioned, the PowerPoint presentations which we can send, and also our secretariat, Shanti, and the other staff who have been supporting. Thank you very much, and we'll see you maybe at the next seminar that we are planning to organize. And of course, we are having our conference coming up on the 20th and 21st of July. So we like to see you, all of you, plus also maybe you can maybe sponsor a lot of your people to attend that one, which will also give us maybe to enable all of them to get more equipped to the new things that are happening in the professional world. Thank you, and all the very best.
Thank you. Thank you.
Thank you.
Thank you. Thanks all. So we will conclude. Okay. Bye. Thank you very much. Okay.